Silicon Valley Bank collapse, the talk of the town, fear of recessions are setting among people. Is this going to be like 2008 all over again? Silicon Valley Bank, SVB, is a California-based bank running since 1983. And now, it is known as the biggest US bank failure since 2008. Before becoming globally known for its chaotic collapse, SVB was well regarded among the tech community, which has a large presence around the San Francisco Bay Area. You could feel the mania and the panic and the concern and the interest. Sparking a sell-off in equity markets worldwide, the collapse of the Silicon Valley Bank has wiped off 10 lakh crore rupees from the pockets of Dalal Street investors. The stock fell by more than 60% in a single day. The collapse of Silicon Valley Bank could just be the start of a slow-rolling crisis in the US financial system, with more seizures and shutdowns coming. What so terrible happened? And what does the future hold for the US economy and for you and me? Let's uncover the role from the beginning. It's a straight fact that whenever a bank fails, it wipes out the money available to its customers and freezes any capital that's already in circulation. Depositors, borrowers, and owners or shareholders all suffer as a result, as does wider economic activity and often the communities or business sectors that the banks serve. Silicon Valley Bank is the second largest bank failure in US history, but its focus was specific. It specialized in providing funding to startups, venture capitalists, and technology firms. For roughly 4 decades, SVB successfully competed with big-name financial institutions, only to collapse in a matter of days. How? There are many reasons that have shaped this situation, starting with SVB's not your typical lending institution. You might be wondering that what does that imply? Typically, when an individual or business seeks to obtain a loan from a bank for commercial purposes, the bank typically requires information about the financial health of the company, such as its cash flow and assets that can be used as collateral to secure the loan. However, this process can pose a significant obstacle for startups and technology companies, who may not have a well-established financial history or tangible assets to offer as collateral. Because you're a young company that's not yet cash flow positive and you need, at the very least, banking services. You want somebody to handle your payroll and be willing to extend you at least small lines of credit, things like that. When other financial institutions were hesitant to take on the risk, Silicon Valley Bank stepped up and provided funding to startups and technology companies that were previously unable to secure loans. SVB was willing to take a chance on these ventures, even in the absence of an established financial history or collateral. While most commercial banks prefer proven clients, SVB likes to cement relationships with companies when they are economic toddlers. By December 31st, 2022, SVB held $209 billion in assets and $155 billion in deposits, according to regulators. SVB said on its website at the time that 44% of US venture-backed technology and healthcare IPOs bank with SVB. It was among the top 20 largest banks in the country. There was a special expertise around Silicon Valley Bank. A lot of banks may not have participated with startups and tech companies the same way Silicon Valley Bank did. So, how could this happen when the banking industry has been sitting on record levels of excess reserves, or the amount of cash held beyond what regulators require? While the most common type of risk faced by any commercial bank is a jump in loan defaults, known as credit risk, a company may face if a borrower fails to repay a loan or fulfill its financial obligations. It's the risk that the borrower may default on the loan or be unable to pay profit or principal as per the agreed terms. But interestingly, that is not the case with Silicon Valley Bank. So it came down to 2 other big risks every lender faces: profit rate hike and liquidity risk. Let's understand what profit rates risk first and how they turn SVB's plans upside down. Interest rate risk is the possibility that changes in interest rates will affect the value of an investment. This risk is particularly relevant to companies that have invested in treasury bonds with long-term maturities, because these investments are sensitive to changes in interest rates. When interest rates rise, the value of these bonds decreases, and vice versa. This means that if a company holds a significant amount of treasury bonds with long-term maturities and profit rates rise, the value of their investment will decrease, which could negatively impact their financial performance. And this is no surprise that the Fed has been rapidly increasing rates in the US since March 2022. The Federal Reserve has been aggressively raising rates, 4.5 percentage points so far in a bid to tame soaring inflation. As a result, the yield on debt has jumped at a commensurate rate. The yield on one-year US government Treasury notes hit a 17-year high of 5.25% in March 2023, up from less than 0.5% at the beginning of 2022. Yields on 30-year Treasuries have climbed almost 2 percentage points. As yields on a security go up, its prices go down, and so such a rapid rise in rates in such a short time caused the market value of previously issued debt, whether corporate bonds or government Treasury bills, to plunge, especially for longer-dated debt. And as a result of this ever-increasing rates, last week, SVB said it was forced to sell part of its bond holdings at a loss of $1.8 billion, leading to a run on the bank. But things didn't get smooth even after that. One, we can argue that profit rate risk leading to a drop in market value of a security is not a huge problem, as long as the owner can hold onto it until maturity, at which point it can collect its original face value without realizing any loss. The unrealized loss stays hidden on the bank's balance sheet and disappears over time, and that is right actually. But what if the owner has to sell the security before its maturity at a time when the market value is lower than face value? The unrealized loss becomes an actual loss. In SVB's case, this ended up being a big problem when its extra billions were invested in treasury bonds with long-term maturities, and the Federal Reserve raised profit rates, which in turn hurt the value of government bonds. And with the tech sector struggling recently, more depositors took their money out. And that's why, to deal with their own cash shortfalls, SVB began withdrawing their deposits while even higher profit rates were expected, which pushes the cycle of liquidity risk. Liquidity risk is the risk that a financial institution, such as a bank, may not be able to meet its financial obligations as they become due. It is the risk of being unable to quickly sell assets or obtain funding at a reasonable cost in order to meet its cash flow needs, such as to pay off depositors or to cover loan losses. Banks are particularly vulnerable to liquidity risk because they rely heavily on deposits and short-term funding sources to finance their lending activities. If a bank experiences a sudden increase in withdrawals or a decrease in its ability to borrow from other sources, it may face a liquidity crisis and be unable to meet its obligations. To understand SVB's situation, imagine this. You have a piggy bank where you keep all your savings, but suddenly you start taking out more money than you have saved up, and you have to dip into your secret stash. That's what happened to the bank SVB. Their customers were taking out more money than they had in cash reserves, so they decided to sell some of their valuable possessions, which are securities, for a loss of $1.8 billion just to pay back their customers. The call to raise equity sent shockwaves to SVB's customers who were losing confidence in the bank and rushed to withdraw cash. A bank run like this can cause even a healthy bank to go bankrupt in a matter of days, especially now in the digital age. But there is a point that's needed to be addressed, and that is why Fed profit rates only impacted SVB. Why don't other banks come out empty? The answer lies in systematic risk. All banks face profit rate risk today on some of their holdings because of the Fed's rate hiking campaign, and this has resulted in $620 billion in unrealized losses on bank balance sheets as of December 2022. But most banks are unlikely to have significant liquidity risk. But why? Because SVB, the composition of their assets was not in line with industry averages. SVB had 7% compared with the industry average of 13%. In addition, SVB's 55% of assets in fixed income securities compares with the industry average of 24%. The failures over the past week of not only the California-based bank, but also fellow US lenders Signature and Silvergate have prompted jitters across global markets. Such concerns were further fueled on Wednesday, when shares in Credit Suisse plunged to record lows, after the troubled Swiss lender's biggest investor ruled out providing it with more funding. Ray Dalio, the recently retired founder of Bridgewater, said on his LinkedIn page that SVB's failure was part of the very classic bubble-bursting part of the short-term debt cycle, adding that this bank failure is a canary in the coal mine, early sign dynamic that will have knock-on effects in the venture world and well beyond it. What does this mean for the future of US financial banking? No one knows the full picture, but each adding piece of puzzle is making the replica just like the 2008 crisis. This is it for today. I hope you found the video valuable and insightful. If you did, don't forget to like, share, and subscribe. That was it for today. See you in the next one. Until then, peace.